Hello, and welcome to the Oregon Business Matters podcast, brought to you by Oregon Business and Industry, your statewide chamber of commerce. At Oregon Business Matters, we focus on insights, issues, and initiatives that impact Oregonians' shared prosperity and the state's economic health. I'm Angela Wilhelms, President and CEO of OBI, and your host here at Oregon Business Matters. Today, I'm talking with Jared Walczak, a senior fellow at the Tax Foundation. Until very recently, Jared actually served as Vice President of State Projects for that organization. One of the Tax Foundation's best-known projects is, of course, its annual State Tax Competitiveness Index, which was released last fall and unfortunately contained some predictable but bad news for the state of Oregon. So we'll talk a little bit about that. But we are thrilled that Jared has agreed to join us today to talk about the index, Oregon's recent slide in that index, and we'll learn a little more about Jared himself. He now operates his own policy shop, Walczak Policy Consulting. He also produces a free Substack newsletter on state and local tax policy called The Salt Road. So you can check out that newsletter, and we'll give you that URL and everything toward the end of the show. But I know you're going to find him interesting, and we look forward to chatting with him today. Jared, thank you for talking with us.
Well, thank you so much for having me.
Great. Okay, so let's just start a little bit. And I know you've gone out on your own, but you are still a fellow with the Tax Foundation, and we're here to talk about that index. So to get us started, why don't you give our listeners a little bit of information about the Tax Foundation, what it is, what it does, and we'll go from there.
Yeah, the Tax Foundation is a nonpartisan, nonprofit tax policy research organization. Essentially, we're a think tank that is focusing on tax policy at the state, federal, and even now international level. We're focused on what makes a tax code competitive. We care about simplicity, neutrality, transparency. We want the tax code to be pro-growth. So we are looking more at the structure of taxes than we are about some of the other political fights and debates that happen around taxes. And that's what our index is about. That's what a lot of our work is about, trying to help policymakers and the general public understand the trade-offs associated with taxation and to make prudent choices around tax structures and tax competitiveness in their states and really at every level of government.
Yeah, that's great. I know it's been a very helpful resource to a lot of policymakers at various levels here in Oregon. Before we get into Oregon specifically, let's talk a little bit then about that index. The foundation has produced a version of that index for many, many years. In 2025, though, the methodology changed. It was renamed to focus on that competitiveness piece. So tell us a little bit more about that index specifically.
The State Tax Competitiveness Index, which some of you might know under its older and clunkier name, the State Business Tax Climate Index, is a measure of states' overall tax competitiveness, really from a structural angle. It's asking way more how than how much. Rates do matter in this, but far more important for the index is how the revenue is raised. And that was true of the old index, it's true of the new. It was time for a refresh because, frankly, tax changes are happening really rapidly these days. And every year we made methodological tweaks, but you had Wayfair, you had the Tax Cuts and Jobs Act, now you have OB3, you have new international tax regimes, you have states looking at digital advertising taxes, all kinds of new things. We were making tweaks, but it was time to make some larger adjustments, and it was easier to do that with a rebrand, a refresh, a recognition there was going to be a little bit of a gap between old rankings and new. And of course, we do backcast, so you can go back and look and say, okay, what would Oregon have ranked several years ago under this new methodology? So there are some changes there, but we think it better captures what we're going at, which is in this fairly competitive environment we are in right now, nationwide, how are states' tax codes stacking up? And hopefully it's serving as a blueprint for lawmakers and for those who care about better tax policy to not just say, how do I rank, but then to say, how could I improve? How do we compare with our neighbors? Where are we doing well? Where are we falling behind? What are the opportunities to make our tax code more competitive?
Yeah, that's so important. And here we have this conversation about competitiveness all the time because we don't exist in a vacuum. We're competing nationally and globally for investment, for capital investment, for entrepreneurship, for business growth, but also for workers, for families that want to live here, and all of that does relate to the tax code. It might not be the only input that goes into an individual or family or business decision to be in Oregon or operate in Oregon, but it's certainly a piece of it. And I think the one thing we can all agree on is there's no silver bullet tax policy. If there was, we'd all be using it. But it is a competitive landscape. So we appreciate that research very much. Okay, so let's talk about Oregon. In the 2026 index, which was released toward the end of last year, 2025, Oregon ranked 35th nationally, right between Arkansas and Pennsylvania. But we talk about trends at OBI a lot, and for us, it's important for people to know that we ranked 35th now, but just 5 years ago or 6 years ago in the index in 2020, Oregon was 8th nationally. So that's a drop of 27 places in 6 years, the largest drop of any state in that window of time. What led to that? What's caused Oregon to drop so precipitously in its competitiveness?
The single biggest factor was the implementation of the cap, the now 0.57% gross receipts tax that Oregon implements above and beyond the corporate income tax. Oregon is one of only 2 states that has both a gross receipts tax and a corporate income tax. The other is Delaware, that is another state without a sales tax, and a state that has some other things that are fairly competitive, but counterbalanced by that GRT. This is actually a reasonably high rate GRT. Sometimes when we hear rates like 0.57, that sounds so low until you understand what a gross receipts tax is. But one point of comparison here, Ohio has a similar tax. In fact, while there's some differences, this was partially modeled off of Ohio's. Ohio's rate is 0.26, and they don't have a corporate income tax. So the adoption of that was very significant. Another factor was that after the Tax Cuts and Jobs Act, you had the creation of GILTI. Oregon conforms to that. Some other states don't. In fact, some states in the intervening years after 2018, 2019 through 2020, we're starting to decouple from that. Oregon includes GILTI at a 20% inclusion. So in the minority of the states taxing that international income. One thing that will improve a little for Oregon, but Oregon is among the states that have been phasing down first-year expensing of machinery and equipment as the Tax Cuts and Jobs Act was doing that, and that was the case as of the snapshot date of the last index. But Oregon follows the federal government. So some states were better than the federal government, but Oregon will snap back with the changes in OB3. That will be a slight improvement. But the other aspect, in addition to that really primary mover, which was the adoption of the cap, is also that other states have been in a very competitive environment right now. You see so many states cutting individual income tax rates, cutting corporate tax rates, eliminating, say, their throwback rules, which Oregon still has on its corporate income tax, improving their net operating loss provisions, where Oregon's a little behind the average, improving their withholding and filing thresholds, where Oregon has a one-day withholding threshold, reforming their unemployment insurance taxes, where Oregon has a very large taxable wage base compared to most states. So in a lot of cases, it's not just that Oregon has made things worse, although in some cases it has, but in some of the areas where Oregon is worse than average, other states have gotten substantially better over time. So it's that combination of factors that, honestly, you can lose ground just by standing still, especially over these last few years. But Oregon has in fact doubled down with the cap, with certainly the very high local income taxes, especially in Multnomah County. You look at the taxes in Portland and Multnomah in Metro generally, and those aren't a huge part of our index, but they're part of it. And you just see how heavy those taxes are on pass-through businesses, on individuals in those jurisdictions. All of that gets factored in. Lacking a sales tax certainly helps Oregon in our rankings. It would be worse without it, but a lot of these other things are driving Oregon down.
Yeah, I want to unpack a couple of those things a little more if we can. So you just hit on one of the things I was going to ask as a follow-up, which is it's important for our listeners to know that the index does factor in Oregon's absence of a traditional sales tax. I got to be a little careful here because we believe the gross receipts tax is a sales tax of sorts. And so, but we don't have a traditional sales tax. We don't hide from that fact. But that is already factored into that competitiveness, correct?
It absolutely is. Oregon would look far worse without it because Oregon ranks 49th on corporate taxes, 41st on individual income taxes, 28th on property taxes, 41st on unemployment insurance taxes. The only way you get to 35th overall is that category of sales and excise taxes, you rank fourth. So, you have the 5 so-called nomad states, the 5 states without a traditional, general sales tax. One of those, Alaska, does have local sales taxes. So there's 4 of you left. You rank 4 out of those 4 because your excise taxes are higher than the other 4, but it's that ranking on the sales and excise tax category that is pulling you to 35th. You would be certainly in the 40s without that.
Yeah, thank you. That's a good clarification. The other thing you mentioned in that explanation is that we might see Oregon, bounce back a little or improve slightly on a competitiveness basis because we connect to the federal tax code. So some of the benefits and provisions that have been put into place through OB3, as you refer to it, HR1, for some of our listeners, they'll know it as, but basically it's the big bill from last year. What would happen if we disconnect from the federal tax code on those provisions?
A lot hinges on this for Oregon and several other states that are struggling with this question of whether to conform to these provisions because, Oregon has historically had the rolling reconnect, and that's been in doubt now, whether the state will continue to conform to these provisions. If the state were to decouple from important business expensing provisions, reversing the current position the state has, the posture the state's had with full expensing of machinery and equipment, that would immediately make you worse than the top 20 or so states that are getting full expensing in place. If you were to go further than that, as a couple of states have looked at, Pennsylvania, Michigan, now DC, have decoupled from first-year expensing for research and experimentation. And that's a real issue in a handful of states where this long-standing provision where just about everyone, from the 1950s, 1954 to 2022, federal government and any state with a corporate income tax allowed first-year expensing for research and development expenses. And that was amortized as a temporary thing under the TCJA. Honestly, it was never supposed to happen, right? Basically, it was a pay for to make the bill seem less expensive, the Tax Cuts and Jobs Act seem less expensive, with the drafters just convinced no one would allow it to happen. And they played a game of chicken and they lost. And HR1 fixed that, but now you have states saying, well, we're not sure. We're not sure if we're going to reconform to this provision.
Yeah.
And this is something I've written about a lot for Tax Foundation and elsewhere, but if a state doesn't, that's really bad for research and development, which most states want to encourage, not discourage. That would slide your rankings even further. So there are some things hinging on this choice. If you remain in conformity because you conform to some good things, you might get slightly better in next year's index. If you were to decouple, you would slide further than you are already now. And honestly, the index is just an indicator. It's
Right.
great to have a good index rank, but it's just what it's pointing towards. And what that would be pointing towards is a far less competitive tax code that's more complex because taxpayers need to essentially file their taxes in a different way, especially multi-state corporate taxpayers dealing with very different systems, dealing with different rulings, different guidance. The state itself couldn't rely as much on the audit functions of the IRS, and then potentially having far worse business provisions because they're in stasis in this period when a lot of things have started phasing out or expiring, rather than the restoration that happened under HR1.
Yeah, and I think it's just so important to keep that in mind. And I appreciate what you said, because we also are very careful around here that any one ranking at any moment in time is not the point we generally try to rely on. It's the trend, it's the direction. It's this point you made earlier about you can actually fall behind by standing still. We talk a lot about putting down the shovel. Let's not, we have a hole to dig out of here on a lot of fronts. Tax policy is one of them. but let's not make the hole deeper. Let's put down the shovel, and also we need to climb out of the hole. You can't just put down the shovel. So I think that's really important, and I think you mentioned a couple states in here that are also in this conversation. I want to talk about that for a second. I mean, sometimes it's easy for political leaders to sort of dismiss rankings or to dismiss policy ideas, brushing them off as, well, we're not like that state, or we're not, that's not us. Well, okay, that's true. We're all different. 51, if you include DC, very, different structures, different codes, different advantages outside of tax policy, different disadvantages outside of tax policy. But, there are states that have similar political sensibilities to Oregon, that are looking at tax policy as a way to improve their competitiveness or grow their economy or incentivize business relocation or growth. Can you give us any examples from some of those states that folks here might say, yeah, they're not too far afield of Oregon politically?
Yeah, absolutely, because obviously there are differences in what tax policy goals look like in states with different ideological balances. But you see a state like Pennsylvania, for instance, where a Democratic governor has championed corporate income tax relief and improving the structure of business taxes by fixing their very out of order net operating loss provisions, improving a lot of the corporate tax provisions that were just out of line with the rest of the country. Unfortunately, they did as this temporary expedient, decouple from R&D. I'm hopeful they're going to restore that because they had made a lot of progress in recent years. You look at what Colorado has done, state that has gone from purple to blue, supermajority Democratic legislature, Democratic governor, and they have focused on some important tax relief and tax competitiveness issues, trying to ensure that business property taxes don't rise the way that they had been scheduled to rise, making sure that they did remain conformed to these HR 1 provisions when there had been some question about that, putting downward pressure on the rate, including the corporate rate, resisting some bad ideas in recent years. And you just see them getting better in some important measures. Honestly, even states that don't have a very good record have sometimes done the right thing in areas where it's a question elsewhere. Like California, for instance, has not implemented GILTI, or what will now be and NICD, the tax on net CFC tested income. It's an international income tax, essentially. And it's really bad policy. It ultimately hurts the states imposing it because it penalizes the decision to operate more in that state, because the more that you have sales in that state, the more you operate in that state, the more you bring in this really unrelated international income for taxation. So this incentivizes that. And California has not done that. California has decided to stick with some of the older definitions, like when the federal government was phasing down R&E, California stuck with it. So even a state like California that has not always been at the forefront of tax competitiveness, and certainly right now is having some active discussions about wealth tax, has said no to things that Oregon has said yes to or has been open to. So you have this divide even among states that maybe have fairly similar politics, fairly similar backgrounds in some ways. And these are going to be important debates playing out because a lot of income can be mobile, jobs are mobile, capital investment is very mobile. And as states make these really significant decisions around how they're going to treat capital investment, how they're going to treat business growth, it is going to further shift activity to states, to other states.
Yeah, that's important. And I, for listeners who are less familiar with some of these more complicated international tax provisions, if you really want us to dive into those for a whole nother episode, send us a note and we can do that. They are fascinating if you're a tax nerd like some of us, and they are complicated, but they're certainly going to be part of the policy debate here in the coming years. So, Jared, I want to ask about something that we talk about at OBI a lot, which isn't about a specific tax itself, but is about part of the structure and it's indexing. So for example, Oregon has high personal income tax rates, but the income level associated with those rates is not indexed. It doesn't grow over time. The estate tax is another one. We have a very onerous and low estate tax threshold, but that threshold doesn't grow over time. And the most acute example for a lot of businesses is also the corporate activity tax, or the CAT, where the threshold to pay that gross receipts tax, which again is on gross receipts, not income or profit, that threshold is $1 million. Again, not indexed. So $1 million in 2019 is not $1 million today, and certainly won't be in the future. We find this to be also a competitive disadvantage, and something that policymakers really need to take seriously and think about changing. What are your thoughts on indexing generally?
Indexing is important if you want to avoid unlegislated tax increases. You have what's called bracket creep, where over time, larger shares of income are subject to higher marginal rates, even though it's not more income in real terms, it's just a higher dollar amount in a nominal way because of inflation. So, Oregon, of course, has the four rate individual income tax, with a top rate kicking in at $125,000. And, $125,000 now is going to be very different than $125,000 10 years from now. Sort of an extreme case of this, the state of Alabama has a multi-rate, multi-bracket individual income tax that doesn't look like one. It looks almost flat, because the top rate kicks in at $3,000. And when they adopted that, close to a century ago, that was high earners. It was only the wealthy who were paying that. And now, of course, it's everyone, because it's $3,000. And Oregon's a long ways from being there, but that's what you do. Over time, this erodes the value of those different rates and brackets, and suddenly people are paying much more. And of course, with the CAT, this is highly significant. That $1 million threshold means less and less over time. The estate tax means less and less over time. It makes sense to index these for inflation to ensure that you don't have these unlegislated tax increases where inflation is sort of hitting people twice. Not only is everything costing them more, but their taxes are larger, not just in a nominal way, but they're paying more in taxes. A greater share of their income goes to taxes because of the lack of inflation indexing. Inflation indexing really became a popular policy in the late 1970s during the stagflation era. Many states adopted it. The federal government adopted it. It's time for Oregon to consider doing the same thing.
Yeah. All right. Thank you. Well, we are running out of time, but I want to give you a chance is there anything else about the State Tax Competitiveness Index, the Tax Foundation, your other work, or Oregon's work that you think our listeners need to know before we sign off?
You're talking about all of the important things. Inflation indexing is important. Certainly the conformity date is going to be a salient question. Rolling conformity is the way that most states go, the way that I think Oregon should continue to go. You can have debates about whether or not to conform to specific provisions. Obviously, there are the personal deductions that are temporary that Oregon, unlike most states, would be in line to bring in. Most states are not in line to bring in the deductions for, say, tips or overtime or auto loan interest. That's rare. And those are questions that lawmakers can address without going to that question of should we conform to the current version of the Internal Revenue Code. So hopefully lawmakers will understand the importance of that consistent, continued conformity, and of course conforming to those business tax provisions, which are not special benefits, which are simply proper treatment of business investment, which is really, it's an expense. And if you have a tax on net income, you do not want to be taxing those expenses even for a certain period of time. So, this is something I've written about extensively at the Tax Foundation. I've had a number of pieces on my Substack actually also about this, kind of breaking down how a few of these work. But we want to be a resource to you, to your listeners. That's what the Tax Foundation is here for. These are important debates, important deliberations, and we just love to keep talking about them.
Well, thank you. And why don't you give our listeners the website where they can find information about the Tax Foundation and, of course, your Substack URL as well?
Yeah, so the Tax Foundation's website is taxfoundation.org. We have lots of research there, state-specific, national issues, really anything you want to find on tax policy. I hope you can find it there. And then my Substack is saltroad.substack.com, salt as in state and local tax. Certainly if you want to dig more into some of these issues, you can find pieces on both of those websites that should be helpful.
Terrific. Well, for folks like me, and of course for many businesses and individuals in Oregon, state tax policy is important and fascinating. We could probably talk about it for a lot longer, but we'll leave it there for today. See what unfolds here in the upcoming legislative session and beyond, and maybe we'll have you back to talk about our ranking again when we see the next report later this year. So Jared Walczak, thank you for joining us today. Thank you, listeners, for tuning in. The Oregon Business Matters podcast is a production of Oregon Business and Industry, the statewide Chamber of Commerce. Our episodes can be found on all your top podcast platforms, including Spotify, Apple, and YouTube. For more information about OBI, visit OregonBusinessIndustry.com. Thank you, listeners, and thank you, Jared.